To understand the hidden risk in modern state economies, look what happens when a government tethers its financial existence to a single localized industry. Alaska policymakers are currently staring down a deceptive math problem: how to close a persistent budget deficit. A 2026 ICER study measured immediate jobs lost for every $100 million raised. Reducing the state workforce eliminates over 1,000 jobs. Cutting the permanent fund dividend costs about 375 jobs. But raising taxes on oil companies results in an almost negligible 44 job losses. On paper, this makes taxing the localized petroleum sector look like the undeniable mathematically optimal choice. It provides the revenue while insulating the broader workforce. But relying on this static math creates a devastating paradox. Choosing the tax with the lowest immediate job impact actually triggers the greatest long-term macroeconomic damage to the state. Static spreadsheet models fail because they ignore dynamic market psychology. They calculate immediate friction, but miss how businesses change their behavior over time. The hidden penalty here is fiscal volatility. This is the chronic unpredictability of state revenue, and it acts as an invisible drag that actively deters long-term capital investment. We can track exactly when this penalty activated. Between 2014 and 2015, a global collapse in oil prices launched Alaska into a period of extreme fiscal uncertainty. By tethering daily state operations directly to those wild price swings, the government unintentionally engineered a paralyzing business climate by 2016. Companies couldn't predict future tax rates or infrastructure spending. This graph illustrates the macroeconomic drag of unpredictability. As this jagged oil revenue line spikes, it actively drags actual economic output down. The resulting red area shows an estimated 2 to 3% of the state's total GDP erased since 2016, solely from unpredictable revenue. Optimizing a tax policy strictly to minimize immediate job losses chains the entire state economy to a volatile revenue stream, ultimately destroying broader economic growth. To see how extreme this instability is, we can compare 15 years of state revenue data compiled by the Pew Charitable Trusts. The narrow horizontal channel represents sales tax revenue, the most predictable income. Overlaying personal and corporate income taxes widens the channels into moderate volatility bands, but superimposing severance taxes on petroleum forms a massive, violently oscillating waveform of extreme peaks and valleys. The only other state relying this heavily on severance taxes is North Dakota, which experiences similar, though slightly less severe, revenue whiplash. Excluding earnings from its sovereign wealth fund, Alaska possesses the single most unstable revenue architecture in America. This level of macroeconomic abstraction translates into direct operational penalties that the state government has to pay out of pocket. State governments finance their daily operations and large infrastructure projects through the municipal bond market, issuing debt to investors. When a state relies on volatile revenue, investors demand a risk premium. Just a 30-day delay in passing a state budget directly spikes borrowing costs on state bonds by 10 basis points. A basis point is 1/100th of a percentage point, and on hundreds of millions in debt, that equals a massive financial penalty. Fiscal volatility is a literal, measurable tax on the state's credit. We can observe how this unpredictability repels capital in real time. Recently, the administration attempted to attract a massive corporate data center to the state. Data centers require immense, immovable infrastructure. Companies commit hundreds of millions of dollars in upfront capital to build facilities they plan to operate for decades. State officials offered an aggressive competitive pitch: abundant energy resources, a naturally cool climate ideal for server cooling, and absolutely zero state taxes. The primary competitor for this project was California, a state notorious for imposing a heavy corporate tax burden. The prospective investor explicitly rejected the zero tax environment. Having no structured tax regime in place meant the state could implement unpredictable levies at any moment, creating infinite future volatility. The corporation chose California because knowing the exact rules of the game allows for accurate financial modeling. They can calculate a known 20-year tax liability. They cannot model chaos. This reveals the predictability premium. Capital allocators will willingly absorb a high locked-in tax burden to avoid the unquantifiable risk of an unstable zero-tax environment. Economists call the underlying structural pathology driving this investment deterrent the Alaska disconnect. In a typical state economy, local business growth organically generates higher sales and property tax revenues. When the population prospers, the government has the funds to support that growth. Alaska's primary revenue driver is entirely exogenous. Income from petroleum taxes and royalties is dictated by global oil markets, not by local economic activity. The permanent fund's investment earnings are similarly detached. Its returns are dictated by Wall Street stock fluctuations, operating independently of the local economy. This total macroeconomic decoupling creates localized crises, best illustrated by the Anchorage School District paradox. Imagine the local economy, the first gear, is booming. A surging population demands new schools, and the gear spins rapidly. But simultaneously, oil prices crash. The second gear, state revenue, completely stalls and turns red. The treasury empties just as growth demands funding. Until state revenues are recoupled to domestic economic velocity, local prosperity will continuously trigger government insolvency. Reevaluating the 11 fiscal options from the Iser study requires shifting the metric. Instead of looking at immediate job losses, we have to examine burden distribution. This matrix maps how different policies distribute the financial hit. Highlighting a broad-based sales tax reveals it directly couples state revenue to local economic activity. As the pie chart separates, it highlights a unique advantage. A broad sales tax exports up to 27% of the burden to non-residents, capturing revenue from seasonal workers and tourists. We can contrast this highly distributed model with the friction of utilizing permanent fund dividend cuts to close the deficit. Cutting the dividend is highly regressive. It drains 2.8% of disposable income from the poorest households, but only 0.06% from top earners, who are able to utilize federal income tax offsets to absorb the loss. Relying on dividend cuts acts as a severe, localized penalty on residents. Sales taxes minimize internal friction by pulling in outside capital. The most advanced recommendation from the research moves beyond single-lever solutions, exploring strategic policy combinations. By pairing two opposing economic forces, a state can actually achieve budget-neutral stimulus. Looking at this model, the process establishes a baseline. A blue block representing a stable revenue source, like property tax, drops into place. Next, a green block locks in, representing predictable revenue funding expansionary policy, like capital projects. When the two blocks emerge, the macroeconomic output is striking. The trend line rises, generating net positive employment gains. In a modern economy dependent on massive, long-term infrastructure investment, stability is an asset class of its own. Clinging to the illusion of low-impact petroleum taxes guarantees the devastating cost of permanent fiscal paralysis.